Big time drama filled day for SoFi stock. They just reported earnings this morning before the bell, and the market reaction to those earnings is certainly a negative one. The stock touched as low as $9.79 during trading today, but as of recording this video, at the market close, the stock was $10.47. In the after hours, it's up 1 cent per share, up to $10.48. We'll see where it shakes out in the post market today, but we're down about 6.5% on the trading day. So in this video, we're going to talk about whether or not I think SoFi's downward move today was justified. And of course, we're going to talk about the underlying business fundamentals. We're going to talk about that Q3 report, the things I thought were great inside there, the things I thought weren't so great inside there, and why this stock might be down today. When you see a stock down 6+% after their earnings, you probably would assume they missed on some numbers. Maybe they missed on revenue. Maybe they missed on earnings. Maybe their guidance was weak. We'll talk about what happened in SoFi's report here in just a little bit. I'm really excited to get into this video, but first, if you're new here, I'm Austin. I'm a co-owner of CloudBusinessSuite.com. I'm also a stock market investor, and most importantly for this video, I'm a SoFi shareholder. It is one of my largest positions in my entire portfolio. So needless to say, I was heavily anticipating these earnings. Real quick, if you're not subscribed to the channel, help us out on that short-term goal of getting to 5,000 subscribers if you're not subscribed already. Appreciate you doing that. Let's jump into the video. So we're going to start by going through their Q3 earnings report. We're going to talk about the good things, the great things, the not so good things. I want to dive in. Let's start with the headline numbers. Record adjusted net revenue, with that revenue growth accelerating to 30%, driven by a crazy 64% combined growth in financial services and tech platform segments. And really important, that represents 49% of the total revenue inside the quarter. The management team has had a goal of getting a split between financial services and tech platform being 50% and then lending revenue being 50%. They are 1% away from that. We can basically say they've met that goal. They have hit that number. That is a really important milestone to diversify the revenue streams for SoFi. They had an impressive 35% member growth once again. These are year-over-year numbers. And the company recorded $174 million in capital light fee-based revenue, and they say reinforcing strength of the increased mix of higher ROE revenue, return on equity revenue. The reason that highlight is so important is that $174 million of revenue they had in this quarter, they don't have to expand their balance sheet like crazy and take on more risk in order to get that fee-based revenue. The fee-based revenue is going to allow them to keep a very lean balance sheet in comparison to a lot of other banks out there. So this fee-based revenue is very important for SoFi, and it's really impressive that they were up over 100% year over year on that fee-based revenue. And then the last headline remark from the management team is that they raised fiscal 24 guidance. Very important. We'll chat about that here in a little bit. So first, let's talk about the revenue and the EPS. The revenue, like we said, is up 30%, and that is an 8% beat from what was expected. Expected was about $634 million. Reported was $689 million. Like I said, more than an 8% surprise. When we're looking at earnings, they were expected to report about 4 cents of EPS. They reported about 5 cents of EPS. Also a very big beat, about a 17% beat when you look at the raw net income numbers. So yet another quarter where the management team has been able to come through and absolutely crush expectations. They have a history of crushing expectations. Management teams that have a history of crushing expectations typically get very good returns for shareholders over time. Let's move on to individual segment results. Financial services revenue grew 102% year over year to a record $238.3 million in Q3, up from the prior year's $118.2 million. That is a crazy swing. 102% growth is absolutely ridiculous. Let's dive a little deeper. Net interest income is up 66% year over year. Non-interest income is up 235% year over year. Total net revenue financial services, like I said, was up 102%. And then directly attributable expenses was only up 20%. When you have total net revenue for the segment up 102%, and your directly attributable expenses for the segment is only up 20%, the margin is going to absolutely explode. In the year ago quarter, they had a 3% margin from financial services. In this year's Q3, they had a 42% margin in the financial services segment. That is the craziest swing I've seen in a year over year span. Very, very impressive. SoFi is doing it at the highest level. And what's even more impressive about that 102% growth number in terms of financial services revenue is that the products were up nicely, 33%, but that's nowhere near the 102%. So they're pulling in a lot more revenue per product than they were a year ago or even 1 quarter ago. So that is very, very important. When you look at the financial services segment by itself, that was an A+ quarter, almost perfect. Okay, let's move on to the lending segment. This is their largest segment in terms of revenue and in terms of profit for now. Financial services segment, as we just saw, is catching up very quickly, but for now, lending is the majority of their revenue and the majority of their net income. Lending revenue was up 14% year over year, which is great to see because the guidance has been not so great for lending revenue specifically. They had said for many months, many quarters, that 2024 levels would be about 92 to 95% of the revenue from the lending segment of the 2023 levels, meaning it would be down on a year-over-year basis. So to see this 14% growth number in the lending is a good sign that the easing that the Fed is doing is going to help SoFi in a major way on the lending side. Directly attributable expenses to the lending segment were only up 10%. So when you have revenue up 14% for the segment and expenses only up 10% for the segment, we're going to get a nice margin bump. On a year-over-year basis, the margin bump was up 200 basis points, which is 2%, up from 58% all the way to 60%. Origination volumes were up for all loan types. Personal loans 26%, student loans 3%, home loans 38% for a total of 23% up in origination volumes. All 3 total lending products were also up 23% for personal loans, 9% for student loans, and 19% for home loans. Given their prior guidance of down a little bit to flat in terms of lending revenue, based on all of that and the margin expansion, I would give the lending segment an A as well for this quarter. Okay, now on to the third segment, the technology platform. So the technology platform, this is a bit of a mixed bag here. One, they've got decent growth. They've got 14% growth year over year from 89 million up to 102-ish million. But bad thing is that the directly attributable expenses are up 21% year over year. So when I only have 14% growth in revenue for the segment, but expenses are up 21% for the segment, margins are going to take a hit. That is never a good thing to see margins going down, especially for a growth company that's supposed to be expanding margins like crazy. Q3 2023 margins for the tech platform were 36%. Q3 of 2024 margins for the tech platform were down to 32%. Not what we like to see, not a good sign, and they didn't give any commentary about it inside the earnings report. So if I had to give the technology platform results a grade for this quarter, I would give them a D. And there's 2 main reasons I would give them a D. One, 14% revenue growth is not really good enough from the tech platform, if I'm being totally honest. I want to see higher revenue growth from the tech platform. Their guidance was pretty soft on tech platform as well. We'll get to that in a little bit, but I want to see more growth from the tech platform. And if we're not going to have strong growth from the tech platform, we've got to keep the expenses down so that we can at least expand the margins and make that business segment more profitable in terms of a percentage. They did the exact opposite. They have low revenue growth, 14%, and they have increasing expenses as a percentage of that revenue. Not a good thing. That's why we saw that margin decrease. I don't like that. I've had qualms with the technology platform in the past. I think it could be one of the most powerful things in all of SoFi's business, but it just hasn't been that yet. Almost every quarter, I have some kind of a complaint about the tech platform. There was a few quarters where I was getting really excited about the tech platform at the beginning of this year, where I thought the tech platform was really getting on the right track, but this was definitely a step back, and that's my main disappointment with this earnings. Does this segment's results sour the entire earnings report for me? No, absolutely not. This was still a very, very strong quarter, but it's definitely the sore spot inside this earnings. And now let's talk a little bit about guidance. So for the full year 2024, management now expects to deliver adjusted net revenue of $2.535 to $2.550 billion, which is $85 million in their prior guidance. This implies 22 to 23% annual growth versus the 17 to 19% expected previously. This guidance now assumes, this is a really important sentence, This guidance now assumes lending adjusted net revenue will be at least 100% of 2023 levels. That is a huge statement right there. That's one thing I absolutely wanted to see inside of this earnings report, was some commentary that the lending revenue would be in a better spot in the back half of 24 and into 25. So now we have guidance that it will be 100% of 2023 at least, if not a little bit higher than that. So we're actually going to probably see some lending growth based on SoFi's ability to beat and raise every single quarter in Q4 of 2024. They're probably going to beat their revenue guidance that they're giving for the lending segment right now based on their history. It's a really, really big deal because right now, lending in terms of revenue is their biggest business segment. Lending in terms of profit is their biggest business segment. Whenever Wall Street's looking at this stock, they're thinking about the next 6 to 12 months. They're not like you and me thinking about the next 6 to 12 years. So in the next 6 to 12 months, if lending gets back in a better spot, Wall Street is going to allow SoFi to have a lot of upward momentum. They also provided guidance on financial services and tech platform. Financial services segment revenue is going to grow more than 80% year over year, and tech platform revenue will grow low to high teen percentage year over year. The tech platform, I really want to see more growth in that. That is not strong guidance for the tech platform. I want to see stronger guidance. I want to see stronger growth for the tech platform. And like I said earlier, if we don't see stronger growth, I want to see expenses being kept in check. Expenses need to rise slower than revenue in order for the margin to expand. That's what we've got to see from the tech platform. I'll be watching that extremely closely in Q4. We've also got major raises in terms of profitability. Management now expects to deliver adjusted EBITDA of 640 to 645 million, which is above the prior guidance of 605 to 615. That's going to represent a 25% adjusted EBITDA margin. And even more important than that, we now expect full year GAAP net income of 204 to 206 million. Well above the prior guidance of 175 to 185 million, and that's going to equate to 11 to 12 cents of GAAP EPS for full year 2024, above the prior guidance of 9 to 10 cents. Very important that we're seeing them beat on EPS. The margins are expanding. Yes, we talked about the tech platform. It had its woes, but lending and tech platform, those margins are expanding and they're making them more profitable quarter after quarter. It's huge that they stayed profitable in Q3 of 2024. I had no doubts that they would, but they're also guiding that they're going to be profitable in Q4 of 2024 as well. We've basically hit the point of no return with profits for SoFi. It would take a colossal disaster in order for them to ever be EPS negative again. This stock is going to be eligible for S&P 500 inclusion if they get one more quarter of EPS profits. Does that mean they're going to get added right away? No, absolutely not. We've seen many stocks be eligible for S&P 500 inclusion, and then it can take up to a year or sometimes 2 years before they even get added to the S&P 500. So do I think this downward move of about 6% is justified? No, I don't think it's justified. I actually, when I read through the earnings report for the first time, I expected that today SoFi would be flat. They had so many really, really amazing things in this quarter, but they also had a business segment whose margins decreased, and they gave somewhat weak guidance on that same business segment, the tech platform, okay? Yes, they had a great revenue beat. Yes, they had a great EPS beat. Lending segment did great. The financial services segment went absolutely crazy, and 90+% of the guidance numbers they gave were amazing raises. But let's not forget, the stock was up 42% in a 1 month span leading up to earnings. You need a literally perfect earnings report in order for the stock to keep on moving up and keep that momentum behind it. We didn't have a perfect earnings report. There was a couple things in here that were a little bit worrisome. If there's just a few things that are worrisome and you're already up 42%, the stock's going to give back some of those gains. If it had a perfect earnings report, we'd be up and away. If the stock was only up like 5 or 6% going into earnings over the past month, I bet today would have been a crazy green day, 8%, 10%, 12%. But you had already baked in so much of the potential good news that a little bit of that got taken away because the earnings report wasn't perfect. I'm not worried whatsoever at all as a shareholder. I don't think a 6% downward move is necessarily justified, but I thought the stock would be pretty much flat, maybe up or down 1 or 2%. So from my standpoint, the fundamentals are still very much intact. Yes, I'll be watching those tech platform margins in Q4 like a hawk. I'll be watching them super, super close because that was a little bit of a frustrating number for me, but pretty much everything else in the entire report was absolutely perfect. So I can't be mad. The fundamentals are still intact. This was the best quarter they've ever had. Their balance sheet's still in a great spot. They're expanding their margins in their two largest business segments. They're diversifying their revenue. This was a great quarter that Anthony Noto and the team put together. I want to read a Mizuho analyst note. Most analysts aren't super high on SoFi stock historically, but we're getting more analysts on our side. Mizuho analyst notes that SoFi stock was down as much as 9% despite a stellar quarter and believes that bears are confused and worries are unmerited. SoFi is expanding its lending capabilities via its loan platform business, and that's what allowed them that massive fee-based revenue rather than expanding the balance sheet. Anyway, I'm going to keep reading. They're expanding their lending capabilities via the loan platform business to address concerns that it would not be able to grow due to capital constraints. The firm, which reiterated its view that any worries about a capital raise are unmerited. Anthony Noto said that he is not looking to raise capital, dilute shareholder equity, etc. As SoFi's total capital ratio should be above 16% at the end of the year, and this Mizuho analyst maintains an outperform rating with a $14 price target on the shares. That's a $14 price target over the next 1 year. That would be a nice return from here. It's important to get analysts on the bull side, so I love to see that, and I agree with everything he said. I plan on reacting to a Anthony Noto interview that was on Bloomberg. It's a great interview, and when I last checked, it only had a few views on YouTube, so I really want to get everyone to be able to see that video as well. Looking forward to that. Hope you enjoyed this earnings report recap. Let me know in the comments below if you liked this earnings report, what didn't you like about this earnings report, and as a result, did it change your opinion on the stock? Do you now consider the stock a buy? Do you now consider the stock a hold, a sell, etc.? I want to hear your general opinions on SoFi stock, what you're doing with your shares out there. Looking forward to seeing that in the comments. Thank you so much for being here and have an amazing day.